So our next speaker is David Metelerkamp from Industry Insight. David holds a master's degree in economics from Stellenbosch University. How do you know somebody's from Stellenbosch University? Billy? They tell you, yeah. Anyway, so, has been with Industry Insight since February 2015. He's a senior economist and is responsible for the compilation of several industry reports. Now, there we've got another answer for you, Richard. We're trying to get the reports as well, and including the construction industry forecast report, which will be very important to us. So I'm going to hand over to David Metelerkamp from Industry Insight.
Thank you very much. Just to check, can everyone hear me okay? Is everything good? Good morning. Thank you very much for having me. It's an absolute privilege to speak at your conference today. Very interesting times in the South African economy, the political situation, times we haven't this is new to us, it's to a degree, times we haven't seen before, very, very interesting. Sorry, is this? Oh, there we go. Okay, so today I'm going to talk specifically about the global economy, the local economy. These two things in turn shape the construction sector, and I'm going to delve deep into the construction sector. We're going to look at some of the dynamics that have changed over the last few years, as well as look at civils, building, more specifically, look at some of the trends and sort of a general overview. So just a little bit about the company I work for, Industry Insight. We are a very small consulting company, and we focus specifically on the construction sector. It's our niche market, it's our passion, and we enjoy writing reports and delving deep into the dynamics within the construction industry. So we are the #1 knowledge providers of construction business intelligence in South Africa. We have a range of products. This includes, we do forecasts for the industry, we do provincial reports on different markets, we can do specific, more microeconomic focused reports on sort of different sectors. We monitor costs within the industry, we monitor the listed companies, etc. So we really are the experts on strategic information for the construction sector. Most of our clients use our services to strategically plan for the next 2 to 3 years, and really rely on us to sort of understand and contextualize what they are experiencing within their own company. So a little bit of marketing. You can follow us on Twitter and Facebook if you'd like to see some of our opinions on news articles that come out, for etc., as well as some interesting insights and snippets of reports that we release. And you can visit us on our website, which is www.industryinsight.co.za if you like any more information. So to get straight into it, the contents of my presentation today, I'm going to look at the overall, is it a bit loud? Sorry. Down. Is that better? Okay, so I'm going to look at economic outlook. Specifically, I'm going to look at what's happening in the global economy. 2016 was a really, really tough year for many emerging markets, many advanced economies. I'll show you in the slides coming up. 2016 was a really tough year for South Africa as well. South Africa's economy grew only 0.3% in 2016. That is the lowest GDP numbers we've seen since the financial crisis. And as we know, we're in a technical recession. We've had 2 consecutive quarters of negative quarterly growth. So we're going to look at the global economy. We are, however, expecting somewhat of a pickup in the global economy. Then I'm going to look specifically at the domestic outlook, some of the trends, some of the main issues going forward. Talk a little bit about what junk status means for the construction sector. Then I'm going to, using the global outlook and the economic outlook, going to link that into the outlook for the construction sector. Going to look at some of the changing dynamics and the overall trends. There have been some big shifts in the sort of structure of the type of work that's coming out in the construction sector over the last 5 or 6 years or so since the financial crisis. Then I'm going to delve specifically into civil construction and then specifically into building, looking at residential and non-residential construction separately, some of the trends, some of our forecasts, some of the insights. And then lastly, I'll summarize, look at some of our forecasts. So not to waste any more time, let's get into the economic outlook. So as I said, the global economy and phenomenon in the global economy really shape our domestic market. South Africa is an emerging market and is very heavily reliant on, so the world has become very globalized over the last 15 to 20 years. Economies are very much interlinked nowadays. So our local economy is very reliant on the global economy. So it's important to look what's happening globally in order to sort of contextualize what's happening in our economy locally. So globally, as I said, we are expecting a marginal pickup in global growth. This is from the IMF's latest World Economic Outlook. They do forecasts for country-specific GDP growth. And you can see in 2015, the world economy grew by 3.4%. In 2016, it grew only by 3.2%. So there was a contraction from 2015 to 2016. 2016 was really a tough year, but the IMF is expecting somewhat of a pickup to 3.5% in 2017. It may seem small, this is only 0.3%, but in terms of magnitude, that is quite significant. This growth is mainly coming from emerging markets. Some of the advanced economies, such as the US and the UK, are going through more political tensions. We've seen some negative data come out of the last 3 to 6 months for the US and the UK economy. So growth from the advanced economies, for example, is mainly coming from a recovery in the Eurozone, mainly South Europe. Spain and Italy are expected to recover quite nicely from some financial woes in the past. And Canada is also expected to contribute more to the global growth outlook. But really, most of the global growth is coming from emerging markets. What's happened over the since 2014 or so, we've seen a big decline in commodity prices. You can see there's big decline in the oil price and other energy prices since the middle of 2014, as well as agricultural metals and minerals prices. This affects emerging markets quite drastically because they are big exporters of specific commodities, for example. So the global pickup has a lot to do with commodity prices recovering somewhat. So you can see it's sort of, for these three indices, which is global, international commodity prices, the beginning of 2016 was a real low point. And since then, it's picked up marginally, which is going to have quite a positive effect on the global economy and the South Africa's economy specifically. We also quite a big exporter of specific commodities. So looking more at emerging markets are expected, so if we compare it to the advanced economies, they're growing in the region of 2 to 3%. The emerging markets are growing in excess of 4% over the next 2 to 3 years or so. So emerging markets are really what are driving the world economy at the moment. Advanced economies, growth has been extremely moderate. It's been very flat line, low growth, 1, 2%. So growth is really coming from emerging markets. For a number of factors, commodity prices plays quite a big role. China is also expected to grow at 6.7% in 2017. A few years ago, we were very worried about China's economy. They're going through somewhat of a rebalance due to some structural changes. China's economy is actually expected to perform better than it was now if you compare our growth outlooks to the last 2 years or so. And China's economy is massive. The trade they do with the rest of the world, the magnitude is huge. So Chinese economy recovering somewhat, very positive. Brazil is coming out of a very bad recession. You can see Brazil's economy contracted 3.8% and 3.6% respectively in 2015 and 2016. That is a deep recession. So just the fact that Brazil is coming out into positive territory of, even though it's only 0.3%, very positive for the world economy. Russia as well. Russia's economy contracted by 2.8% in 2015 and again contracted marginally by 0.2% in 2016. Russia's economy is also very big. So Russia's economy expected to grow by 1.4% in 2016 is going to have a very significant effect on overall growth in emerging markets. So this is going to affect South Africa positively, this pickup in the global economy. But now looking specifically at the domestic market, as I said, the South African economy grew only 0.3% in 2016 as a whole, the lowest growth we've seen since the financial crisis in 2008, 2009. And as I said, we've had 2 negative quarters of GDP growth or lack thereof, which resulted in what we call a technical recession, which is 2 consecutive quarters of negative growth. But as you can see, we've had a few blips over the years. So these 2 negative numbers for the fourth quarter of last and the first quarter of this year, contextually, it's not as bad as it would seem. Obviously, it's terrible. The economy only grew 0.3% last year, but we are sort of expecting somewhat of a pickup. This first quarter the data for the first quarter was quite a surprise to most economists. We saw quite a big plunge in retail and wholesale trade spending. So it's consumer spending, complete lack of confidence. We have a crisis of confidence in the South African economy as well as the political system or the political environment at the moment. So I like to break up GDP growth into the different sectors from the production side. So on the positive side, the drought is mostly over. We've seen a good rainfall coming back to 8 of the 9 provinces. This has had a very good effect on the agriculture industry, which you can see it contracted in 2015 and 2016 quite significantly. But in the first quarter of the year so far, it grew by 22.2%, coming off quite a low base, but this is very positive going forward. The mining sector has also recovered somewhat. We're expecting the mining sector to perform a little bit better this year compared to the last 2 years, growing at 12.8% in the first quarter. It's quite good. I mean, if you look on the back of negative 4.7% last year, shocking really. So this recovery is somewhat to do with the pickup in commodity prices to a degree. Manufacturing, our biggest sector, is quite a big worry. The first quarter, the manufacturing sector declined by 3.7%. The manufacturing sector is one of the biggest sectors in the South African economy. I think it's about 12 to 13% of the overall GDP of the economy. But really what drove the economy downwards and what's been keeping the economy afloat over the last 3 to 4 years is more consumer spending. And we've seen, so this finance, real estate, business services, and wholesale and retail trade categories contracted by 5.9% in the first quarter. It was quite a shock. So this just shows that there's absolute crisis of confidence, consumers aren't spending, sentiment is at all-time lows, well, not as low as the financial crisis, but it's almost as low. So it's been a real crisis of confidence. The construction sector has actually been, in the past, has been a bit more buoyant relative to overall GDP, which we can see at the bottom here. Of course, in 2009, all the World Cup stadium building, etc., was a bit of a boom. So the construction sector, in a way, avoided the financial crisis to a degree, growing by 7.4%, when the overall economy contracted by 1.7%. And we can see over the years, it's been between 1 and 3%, more or less. But 2016 was a specifically bad year for the construction sector, especially if you look at the GDP data, contracting by only growing 0.7%, which is the lowest since the financial crisis. Actually, before the financial crisis, it was a bad year in 2011. And in the first quarter of the year, it's gone from bad to worse. We've seen the construction sector contract by 1.3%. So, not good. 2016 was a really bad year. 2017, we're not expecting to be much better. I don't have much good news today, I'm sorry. So, looking at the BER Consumer Confidence Index, the latest data point for the second quarter of this year came in at 29 points out of 100. So this just shows that, so this is a financial crisis year, bit of recovery, and since the end of financial crisis, there's just been sort of a slow downward trend in consumer sentiment. And this shows with the retail trade statistics, for example. So this is just to illustrate the lack of confidence. The index going below 30 for the first time since the financial crisis. And as Richard pointed out, South Africa has a huge investment problem at the moment. This is just one example with an article that I saw on Engineering News that looked at a study from the Center for Competition Regulation and Economic Development. They did a project on looking at the top 50 JSE listed companies and looking at their level of their reserves. And generally speaking, this group of companies, which is 65% of the listed market, their reserves are generally between 200 and 400 billion rand. The reserves are currently at 1.4 trillion rand. What this means is they have all this money sitting around, there's no opportunity to invest. They don't have confidence in the economy to invest this money. To contextualize this, in 2016, the total GDP in the South African economy was about 4 trillion rand. So this is 1.4 trillion rand. That's more than 25% of the total GDP in the economy. Investment as a proportion of GDP is sitting at around 10% of the overall economy. Government's target in the NDP was 30%. So we're at a third of the level of investment. When we look at different, more advanced economies, they tend to have a much better mix of things that drive their economy. In South Africa, it's been very reliant on consumption-driven expenditure over the past, since the financial crisis, even leading up to the financial crisis. Investment was a bit higher. But since the financial crisis has been a major crisis, very, very low levels of investment, and this is seriously worrying, because investing in the economy is what adds to the structural capacity which enables us, which sort of is a platform to grow off. Consumption-driven GDP growth is not sustainable. We need structural growth, which is more investment-driven growth. So this also just illustrates the crisis of confidence. If these top 50 companies, for example, had more confidence in the South African economy, they wouldn't have 1.4 trillion rand of reserves just lying in their bank accounts. They would be investing it. They would be investing in structural growth in the economy. But there's just no confidence. Just to contextualize it, not all of the reserves would go specifically for investment. It would be probably 30, 40%, but it's just relative to previous levels, it's extremely high. And there's just a complete lack of sentiment. So the rating downgrade, we've spoken about that. Definitely negative. In my opinion, it's been a little bit, the media has exacerbated the problem a little bit to a degree. It is bad, but it's not as bad as we've sort of been made out to, it's been made out to be. I know a lot of people don't like to hear that. I seem very optimistic to some people, but we have only 2 out of the 3 rating agencies have downgraded our foreign denominated debt, which is only 10% of our total debt mix. About 90% of the country's debt is in local currency. So we are still sitting in investment grade for the local currency denominated debt, but only one level above investment grade. It's panic when we get downgraded to sub-investment grade for the local denominated debt. This is when we're going to see big capital outflows. For example, some of our government's bonds are in world investment grade indices in overseas investment banks, for example. As soon as the debt gets downgraded to junk status, automatically those bonds will be excluded from those portfolios, for example. But what the media doesn't mention is that there's a big search for yield in terms of investment perspectives throughout the world. So when the bonds get downgraded to junk status, for example, we actually saw a big inflow of investment as well. Doesn't quite counterbalance the outflows, but it is also something to just think about. So it's seen as more risky, so as soon as the bonds go to junk status or sub-investment grade, it's riskier, so your yields, it's picking up cheap debt to get a good yield. So that's something that's not often mentioned. But the biggest worry for the downgrades is, for the construction sector specifically, is that it significantly increases the cost of debt for government to borrow. Government finances a lot of their spending through borrowing from international organizations, other countries, for example. As soon as the cost of borrowing goes up, this means it puts pressure on our fiscus. This means there could be less infrastructure spending. Not could be, it means there will be some degree of a cut in infrastructure spending, for example. So that is one of the big worries. And once it goes to the local denominated debt to downgrade it to junk status, that's a bigger worry. And also there could be potential interest rate hikes if the rand depreciates enough with more downgrades to the debt. In my opinion, this is largely priced in to the markets already, and we haven't seen very high levels of what they call exchange rate pass-through, which is sort of imported inflation through exporting. So I'm not too worried about this, which is often mentioned. Interest rates, in my opinion, have reached the peak. They're on their way down now. We saw interest rate cuts in the last meeting. We're expecting another interest rate cut before the end of the year. But our government is very constrained with the tools that they can stimulate the economy in the short term. Generally, a government can either use fiscal policy, which is government spending, to boost the economy, or monetary policy, which is using interest rates, quantitative easing, for example. There's not much scope to lower interest rates significantly, and of course the government has huge pressure on their fiscus at the moment with the rating agencies on their backs. Responsibly, they have reined in spending to some degree, and we've had to have sort of semi-austerity to some degree. Government hasn't been able to spend as much as they would like, and to sort of give the economy a sort of shot in the arm. There's big pressure on the fiscus, and monetary policy is somewhat constrained at the moment. So from a government's perspective, there's very little they can do in terms of short-term policy interventions. We need structural growth. Okay, sorry, I'm talking too much. Okay, so upside risks, I'm just going to quickly go through this. Uptick in commodity prices, low inflation, It means we can have more interest rate decreases, for example. The exchange rate's been surprisingly stable. The global uptick will contribute positively to the economy. And it's important to mention that we've actually had quite stable labor relations over the last 2 years or so, relative to previous years. Downsides, and it's a big downside, policy uncertainty. Complete lack of confidence. The environment is not there for companies to invest. We need political change, we need sort of structural change to just restore confidence, give the economy a shot in the arm. Those 1.4 trillion rand in reserves, that just illustrates how quickly things can turn around to some degree. So overall, we are forecasting GDP growth of 0.7% in 2017. This is a sort of modest forecast. The forecasts range between about 0.5% and 1%. The IMF surprisingly has our economy growing at 1% this year. I think it's a little bit optimistic. So a little bit better than last year, still not good. We are expecting it still to pick up to 1.4% in 2018, but we need growth of above about 2.2, 2.5% just to absorb population growth, for example. So anything under about 2%, we're still going backwards in real terms. Okay, so to get into the construction sector specifically, a benchmark that we use is the gross fixed capital formation. This is an investment statistic. So this graph shows the overall spending on capital, infrastructure spending and capital growth of the construction sector over the last, since 1980. So what I'd like to point out is that we all remember this time from about 2000 until the financial crisis, construction sector had pretty good growth. Everyone was very happy. Then we had the financial crisis. And then since then, many people disagree with this uptick, but I'll explain now to contextualize it. The dynamics changed. So we saw, so it was a recession year to some degree, flat growth, an increase, and over the last 2 to 3 years, the construction sector has been flatlining. In real terms, there's been no growth. It's been almost the same every year, more negative to a degree. But to explain this uptick, which some people disagree quite fervently about, this period here, since about 2012, 2013, we've seen quite a big shift in the big dynamic changes in the sort of the structure of the construction sector. We've seen quite a big shift in the types of projects coming out, as well as the different, sorry, I'm losing my words here. We've seen quite a shift from large construction companies having quite a big share of the pie to smaller construction companies almost taking over that share. So this is data from Stats.SA on public finances, quarterly financial statistics. So you can see in 2012, large contractors took about 60% of the overall construction pie. Since then, there's been a big decrease, and they're sitting at roughly about 40% of the overall pie. So that's they've about a third of the overall share that the large contractors had in the construction sector has gone to the small contractors, who have grown from about 16% to just about 40%. So there's been a big shift from large to small contractors, which is why a lot of the higher end clients do not believe that there's actually been any growth over the last 3 to 4 years. It's because it hasn't gone to the higher end of the construction industry. It's gone to the smaller contractors, for example, more of the emerging contractors. Just to illustrate this point further, this is the JSE index since 2010, and this is the market cap of the listed contractors since 2007. So we had the financial crisis here, JSE tanked, the listed construction sectors tanked along with the JSE. Since then, the JSE has almost doubled since 2008. It's been very flat over the last 2 to 3 years. But we can see that the listed contractors, which is the nine big listed contractors, they have lost more than half their value, more than half of their market cap over the last since 2007. So this just illustrates there's been a huge shift from the bigger construction companies to the smaller guys. And this is in nominal terms. So they've lost half their value in nominal terms. In real terms, it's more like they've lost 65% or so of their total value. Many reasons for this. So this also illustrates that this is now the awarding of projects. And so we can see that the medium grades, there's been a big increase in the number of medium grade projects that have been awarded. This is like the grade 4, 5s, and 6s, 7s for example. There's been an increase in those grades, but there's been a flat growth in the grade 8 and 9 projects that have been awarded over the last few years. Okay, so to delve deep into civil construction, so that's the overall construction, where we are now. That's where we are with the construction sector now. Very flat growth, changing dynamics. So if you look at civil construction, okay, so just a little bit about our data. We have data through that we get through DataBuild, a lead-based service that we aggregate. We can look at the value of construction projects that have been awarded. We can look at the number of projects that have come out to tender, for example. We can look at the number of projects postponed, cancelled, etc. Very nice, unique data that we use to gauge sort of the overall level of what's happening on a more micro basis in different sectors. In terms of civil construction specifically, we have seen an 11.2% increase in the value of projects awarded in nominal terms over the last 12 months compared to the previous 12-month period. This is a little bit higher than we forecasted 12 months ago, but in nominal terms, this is about 5 or 6% growth in real terms. And as I said, this is more smaller projects. The awarding of higher grade 9 projects has been flat and negative in most cases. What's more worrying is that tender activity has been significantly down. Over the last 12 months, there's been 23.8% less civil projects out to tender in total. That's quite significant, and it is a little bit worrying for the next 12 to 18 months or so. This is a leading indicator, which means we can expect less projects to be awarded over the next 12 months or so, civil projects specifically. Looking at projects postponed and cancelled, very worrying statistics. This is a short-term graph over the last year. We can see that towards the end of 2016, there's been a very big increase in the number of projects that have been postponed and permanently cancelled. Sitting at this moment in time, with June being the latest data point, there have been 231.4% more civil projects that have been cancelled, and 146% more civil projects that have been postponed compared to the same time last year over a 12-month period. It's decreased somewhat so it's a 2.3-fold increase and a 1.5-fold increase in the number of projects postponed and cancelled. So quite worrying. So even though all these projects are being awarded, a lot of them are being cancelled, a lot of them are being postponed in the civil sector specifically. So to touch on the budget, the civil sector and the building markets are driven by slightly different factors. The civil environment is more driven by overall government infrastructure spending, whereas the building market, non-residential, residential sort of stuff, is more driven by the private sector to a degree, more like an 80-20 split on both sides inversely. So looking at government spending over the next few years, this sort of explains to me why there has been slightly more projects, civil projects awarded in the short term. Because for the next 3 years, we are expecting an 8.9% nominal increase in government spending for transport infrastructure and a 6.5% increase in water spending. Again, the size of these projects is more the medium and lower grades. The bigger projects are a lot more scarce. But overall for the sector, this is still relatively positive in quite a depressed environment. Government actually prioritizes infrastructure spending over many other departments, for example. It's one of the last categories to actually get cut if you look at the spending patterns per different categories and departments. So this is something slightly positive, but again, this is in nominal terms. So in real terms, this is 3% growth, which is extremely low. For water, this is flat growth. This is the same as last year, for example. And they split this up over 3-year periods, and it's difficult to track, but this is sort of something somewhat positive in the current environment. Just to illustrate again the sort of shift between the different contractors, this is from one of the SAFSEC surveys where we surveyed large versus medium-sized contractors on the value of their order books. So you can see from 2013, the large contractors their order books have been, so the index is from 100 here in 2013. The large contractors' order books have been completely flat over the last 3 years. So no growth in real terms. The medium guys have actually done quite well. Their order books have doubled, almost more, over the same period. So while there's very flat, low growth, it's changing dynamics. The sector is shifting. The dynamics within the sector are shifting. The overall pie is growing slightly, but the composition has changed quite dramatically in a very short period of time, which is definitely something that we all need to be aware of. In terms of confidence, Civil engineering confidence also at almost all-time lows compared to the financial crisis and this Asian financial crisis in the late 90s. So again, confidence being hit in the civil market specifically, not just in the overall economy, which is what it's driven by. Okay, so that was civil construction, looking at buildings specifically, more of the built environments. I know there are some civil elements in the building environment, but this is looking more at the specific statistics. So we're going to focus on residential market before the non-residential market. The residential market compared to the non-residential market has been slightly more buoyant over the last few years. But if we compare it to previous, look at this fantastic growth before the financial crisis in the overall residential market. This is again the gross fixed capital formation statistics. It's declined and it's been pretty flat since then. Some of the growth that we have seen over the last few years has been mainly in affordable housing. This is largely government funded, not from the private sector. Private sector isn't willing to invest at the moment. But we have seen, for example, if you look at Stats SA's data on the square meters of building plans passed, the one category that does stand out is that there's been quite a good increase in the number of square meters passed for flats and townhouses. So more complex developer-driven projects, which has had quite a nice increase in excess of 20% in terms of the overall number of square meters. Unfortunately, flats and townhouses only makes up about 20% of the overall residential market, so it hasn't been enough to lift the overall residential market, with freestanding houses as well as private. These statistics are exclusively private. So if you can see, there was a bit of an increase in low-cost housings, but it's tanked quite significantly since almost 30% decrease in the number of square meters for low-cost housing. And luxury homes, you can see, has been a pretty clear downward trend in what we call luxury homes, which are just freestanding houses, greater than 80 square meters. That's the way Stats SA splits up the data. And you can see these luxury homes make up the lion's share of the overall pie in the residential market. So residential market, from a private perspective going forward, it's not looking too good for the next 12 to 18 months or so. And as I said, demand for flats and townhouses, this has slightly buoyed the residential market. We've seen the listing. So there are pockets of growth. Overall, on a national level, it's depressed. But there are pockets of growth. In some of our provincial reports, we focus on some of these more metropolitan areas, up-and-coming areas. We've seen the listing of residential-only property funds, such as Bourne and Indu Place, and they posted pretty good results over the last 2 years or so since they've listed. So I'm just trying to illustrate that overall it's depressed, but there are pockets of growth in certain areas. So it's just identifying those areas. Okay, so, and then one more positive thing I thought I'll touch on for the residential market is that the budget for human settlements is expected to expand by 7%, only in nominal terms, but this is one of the only categories in terms of the residential market that we are expecting growth in real terms, is the affordable housing market. These big mixed-use developments, what government calls these catalytic human settlement projects, such as the Cornubia development, Richmond Park, a bunch of these. If you can get involved in those sort of projects, fantastic. And they are out there. And government is expecting to deliver over 300,000 fully subsidized units. So this is more target. Whether they can actually reach the target or not, that's the question. Okay, so looking at the non-residential market quickly. As I said, the non-residential market hasn't fared as well as the residential, so this is more retail. We've seen quite a big boom in shopping centers over the last 4 to 5 years. This has come to an end. Industrial space is probably the only category that's showing some sort of growth. In terms of commercial office space, also seeing negative growth. You can see that since 2014, in terms of growth for the non-residential market, it's been negative in real terms. So looking at the value of non-residential projects awarded, there's been a 16.3% decrease in the value of non-residential projects awarded according to Industry Insights data. In real terms, this is even worse. So there's been less activity. And in terms of future activity, there's been 13% less non-residential projects out to tender over the last year compared to the same 12-month period. So again, not expecting very good growth in a non-residential market. Sorry, don't look too upset. I told you I had bad news. Okay, so this is again just Statistate's data. They break up. This is now privately driven residential, non-residential construction. The only positive category is that we have actually seen some growth in square meters approved for industrial and warehousing space, but that makes up a very small proportion of the overall value of the non-residential market, about 20–30%. Also, with retail and commercial spaces really being the drivers, and there's been a 61% decline in the square meters approved for the retail market, as well as a 12% decline in office space, square meters approved for office space. So quite negative on the non-residential side. Okay, so just to finish off, thought I'll touch on some of the key issues in the sector. Even though the civil environments have showed that there has been an increase in the value of civil projects awarded, we've seen all these projects being awarded, but so many of them have been postponed, cancelled. There's been a big disconnect over the last 3 to 4 years between the number of civil projects awarded, the number of projects coming out to tender and the number of projects that are actually awarded and then actually construction starts without being cancelled or postponed. So this has been a big issue over the last 3 to 4 years. There's never been such a big disconnect with our data. It normally follows each other with some lag, but over the past few years there's been quite a big disconnect. Another issue is the slow pace at which projects have been rolled out by state-owned entities. They have all these big plans and spending that looks good, and the pace at which projects are being rolled out has just not been fast enough. The inefficiencies are rife within our SOEs, and they are the ones who are now spending the majority of our government's budget, which is quite worrying. And this is largely linked to a lack of security related to finance, with consumer-driven tariffs, etc., which again is linked to the overall economy. Business confidence remains a big issue. We have absolute crisis of confidence, and transformation, of course, remains also a very big issue in the sector. You need to have the highest BE level in order to sort of get all the work that you can. Okay, so just to conclude, overall, relatively depressed outlook. As I've tried to show, there are some hotspots on a provincial level. We've seen the Western Cape, for example, have more of a boom in the residential market. We've seen KwaZulu-Natal, for example, have a good boom in the retail market. There have been quite a few big shopping centres that have gone up. So provincially, we can find hotspots, but overall, nationally, the data tells us it's very depressed. You look very depressed. I know the markets, the construction sector is very depressed at the moment, very flat, very low growth, absolute crisis of confidence. Silver outlook, but as I've said, changing landscape as well. Many of our clients, for example, are more involved on the higher end stuff, so they've been hit a bit harder than the smaller to medium-sized stakeholders within the industry. So just to conclude, sorry, I need to go back. Sorry, I have one more slide. Yeah. Yeah. Cool, thank you. So just to conclude our forecasts, we forecast the gross fixed capital formation figures, which we use as the benchmark for the overall growth in industry. Civil industry, we are forecasting negative 1.8% negative growth in real terms. So more of the same, slightly declining. The residential market overall, even though it is buoyant in some sectors, overall we're forecasting negative 3.5% for the residential market in 2017. Picking up slightly next year to 1%, and as I mentioned, the non-residential market not faring as well, we expect it to decline by 4.5% this year. Overall, this means a construction sector that's declining by 2.6% in 2017. So, sorry for the bad news, but it is good to be realistic. It's a good time to sort of think about efficiencies, restructuring, etc., focusing on changing your strategy, adapting to the current environment, realizing that the dynamics have changed, etc. Thank you very much.